Well, Kelly, this has been the exception to every rule. And so, and I think you've written some really provocative pieces on this, starting with the piece you wrote last week or the week before, where you argued or pointed out that the 3-month 10-year had actually steepened on the Fed's first announcement of a 25 basis point cut. And then you quoted Esther George, who said, if the Fed wasn't in the market buying securities, we'd probably have a 10-year at 3.5%. So it may be that I'm wrong about this, but historically, the way you break the back of inflation is you raise rates above the inflation rate. And I was managing money in the Volcker years in the second half. I want to point that out. And stocks, during his tenure, stocks were up 360%. But he raised the prime rate to 21%. That's where prime went. So and inflation was at 14.5. It took a lot to break it. And I think what's different this time is that in normal Fed hikes, you have the reflective phase where the Fed's raising rates to reflecting a strong economy, and then we move into the restrictive phase. Well, in this case, we have PMIs that are rolling over. Usually PMIs are going up when the Fed raises rates, and we've had a year of global central banks raising rates. So I think it's going to be difficult for them to get there, though I wish they would, and I wish they'd do it quickly. I just don't think it's going to matter that much. I think the balance sheet's probably going to matter more.
Well, what you're saying reminds me of what Larry Summers was writing in the Washington Post earlier last week, where he said, they might have to go to 5% or something of that magnitude to achieve those goals. And obviously that's not in the market. So you're kind of saying a lot of this is noise until or unless we get to such a point. And you've looked back at that cycle kind of a little different, but just because it gives a recent example, the early 2000s, what outperformed then? What does it point to in terms of the parts of the market you want to focus on for this kind of difficult time we could be facing?
Yeah, it's somewhat analogous. You're right, though it's not entirely analogous. Rates went from 1% to 5%. I can't remember how many hikes there were. And there were other things going on, obviously, in the economy. But what did well counterintuitively was technology, energy, materials. Those were names that stand out to me. And, we also have rising inflation. And so, as we all well know, but many of those names benefit from that as well. So we like, things like EOG, which is a great natural gas play. Their capital allocation to shareholders has been robust, and they paid 3 special dividends in a year, and they've doubled their dividend. Wow. We like Steel Dynamics, which is, kind of an ESG-ish steel company, if you will. They're trying to find alternate ways to heat the flat roll steel other than just energy or oil. And we like other names in technology and defense.
Yeah, Palo Alto, LHX you mentioned. So let me ask you, when the debate is kind of happening where we have Greg Ip's piece warning it's going to be hard for the Fed to achieve a soft landing, and Carl Icahn warning that we could be in for a very hard landing ahead. And yet you've got some names here in a general sense of being constructive on the market. So what would you tell investors about kind of the range of outcomes we could be facing?
Yeah, I mean, I've seen one soft landing in my career, and that was in '94 with Alan Greenspan after a series of rate hikes. I don't think this is that. So I do think that the economy is going to be, well, we already know it's slowing, and it was slowing before Russia invaded Kuwait. And we also know that earnings have to come down, but nobody has begun yet to revise earnings estimates down. So in this kind of an environment, you want to have reliable growers. Dividend growers are even better because dividend growers are going to be a hedge against inflation. And so many of the names, except for Palo Alto that I mentioned, have strong dividend cultures and policies. And managements are raising dividends. So I don't think it's all bad news. They expect to see the ability to deliver decent earnings. And I think you'll get decent returns in the stock market, barring a serious recession. I don't think we're going to get that. First of all, I think we're a year away at least, and it'll be short and shallow when we do get one, because there's a lot of good things going on in this economy, not the least of which is tech CapEx spending, which drives productivity and people beginning to return to work. Now maybe because they have to with higher levels of inflation. So the participation rate is inching up.